On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. Before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners financial advice provider disclosure statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Morning team, hope you're all well. This is episode 323 of this podcast. I'm amazed by that. At the beginning of this year, we had done 232 episodes. So if my maths is correct, this is number 91 in 2025. Not the last one. I'll do another week ahead this weekend, but this will be the last one of these midweek special topics that I talk about. Doesn't mean I'll go completely quiet over the rest of December and the first half of January. I am sure I will think of other things to jump on here and talk to you about. Maybe I will do a few recap episodes, a few encores. I don't know. I'll think of something. You will hear plenty more from me. But this is the last of the regular programming in terms of those midweek special topics. Number 91. That's amazing. I'm really proud of that. Thanks for sticking with us. I thought I would wrap up 2025 as best I could. A lot happened. We won't be able to talk about all of it, but I'll wrap up some of the key points, some of the moves in financial markets. Then we'll do a little bit of a look ahead to next year, and I'll just share a few initial thoughts about what is in my head as I ponder how markets could look, how economies could look, what investors should be thinking about in 2026. So let's reflect on a challenging and volatile, but a still fruitful 12 months for investors. We started this year with Donald Trump being inaugurated as US president for the second time. We knew tariffs were on the cards, but still in early April, Liberation Day was very much a shock to markets. So we saw world shares fall 16.3% between February and April, just after Liberation Day. Then they rallied 35% over the balance of the year. Trump did back off a little bit. He did soften his stance, and investors became a little bit more comfortable with the outlook. So with less than a month to go, world shares have returned more than 20% in 2025. That's a fantastic return, more than double the long-term average, the average of the last 30 years, which has been, I think, about 8.5% per annum. So north of 20. You cannot be upset about that. European shares and emerging market shares have been the best performers for New Zealand investors. Both of those two regions have returned close to 25% each. Now, a big part of Europe's gain has been due to favourable currency moves because the Kiwi dollar has slumped about 9% or thereabouts, close to it at least, against the euro over the course of that year. Exchange rate movements have been more subdued against other major trading partners, but against the euro, we have seen a big decline. And I think that has happened for a lot of reasons. The European economy is in pretty decent shape. People are optimistic about what you're seeing in Germany, and because people have been looking for opportunities to diversify away from the US dollar, the euro has been the natural beneficiary of that, because if you don't want dollars, and putting aside the likes of gold and Bitcoin, the euro is really the only other big currency that you can go to. So that has been how things have played out across global share markets. Here in New Zealand, our market is up a little less than 3%, so a fairly subdued performance compared to what we've seen overseas. Fixed income has been solid. Domestic corporate bonds have delivered 5.3% this year. That's very close to the long-term average. US Treasury bonds have also performed well. They are up more than 6% this calendar year, so that is the best year in 5. Hasn't been bad. Gold has been exceptional. It's up 60-odd%, the best performance since 1979, while Bitcoin has been the roller coaster that people have become accustomed to. So Bitcoin is obviously the highest profile crypto asset, so it's the one that we'll talk about to represent that whole crypto world. It fell 18% in the first few months of the year, Bitcoin. Then it surged almost 65%, hit fresh highs in October, and then it slumped 32 odd percent. And right now, it's looking like it will finish the year pretty close to where it started. So there you go. Go figure. Putting all of that together, I think most investors will have enjoyed a fairly lucrative year. If you had a middle-of-the-road balanced portfolio, the 60-40 portfolio, something that looks akin to a balanced KiwiSaver fund, you've probably ended up with a return in that 8 to 10% range, a little above the long-term average. As for next year, there is loads to look forward to. I suppose some of the good news is that inflation does look contained. It's far from dead and buried, but it does look contained. We're at 3% here in New Zealand. It's very similar in the United States. Across the Tasman, it's a little higher than that. They'd like it to be a little bit lower. So I think all central banks would prefer inflation to be closer to 2%, 2.5%, but we're certainly in a better space than we were 1, 2, or 3 years ago. Having said that, central banks are still very likely to take a divergent path. They'll all be doing different things. The Reserve Bank of New Zealand here looks to be done. We think that 2.25% is probably the low in the official cash rate. Probably not going to see any more cuts unless you get something happen out of left field next year. So we're probably done. Same with the European Central Bank. I think they've cut to 2%. They're probably done as well. The Federal Reserve in the US, however, still has some easing to do. They'll start this week, we think, and that will continue throughout 2026. And that will be an important driver of sentiment when the Federal Reserve is cutting interest rates and they're not doing it because the economy is headed for a recession and they feel like they need to rescue it, when they're doing it as they just sort of normalize back to where they want to be because inflation has come off the boil. That is usually a good backdrop for asset prices. Policy interest rates still need to rise further in Japan. We're expecting to see a cut potentially this month that would take the policy rate in Japan to 0.75%. That would be the highest we've seen since the 1990s. So Japan is another story altogether. And across the Tasman, the RBA has a bit of a challenging backdrop, the Reserve Bank of Australia. They have got inflation that's stronger than they would like. That's okay because they've got a solid economy, but I think they would rather be able to ease monetary policy a little bit from where they're at. So that is one to watch heading into next year. The US economic outlook is the most important, and I am still optimistic for America in 2026. So you've got falling interest rates, you're not seeing recessionary alarm bells, almost always a recipe for a fairly good environment and some attractive returns from things like the share market. Analysts are also projecting earnings growth of 14% in 2026 for the S&P 500, which is highly attractive. Obviously, that's driven in a big way by the tech sector, by the Magnificent Seven and those AI hyperscalers, so it's not across the board, but it still should be enough to offset any valuation headwinds, unless the analysts are overly optimistic. So we will have to keep an eye on things. But right now, the backdrop looks pretty good heading into next year. I think New Zealand looks interesting as well. In fact, I think we look better than interesting. I think we look good. Our share market has been a significant laggard in recent years compared to global peers. We are still 10-15% below our all-time high, which came almost 5 years ago in early 2021. And you've got other share markets around the world that have been hitting record highs all year. So we don't look as expensive compared to our own history. You've also got lower interest rates that I think will push investors toward the attractive dividend payers on our market. Term deposit rates were 6% middle of last year. Now they're down at 3.5%. So they've fallen by more than 40%. So you've got all of that money that was quite happy at 6% or 5% in TDs, now faced with a 3.5% return before tax, remember. And some of that money will be looking for a better home, looking for a home that will work harder for it. So I think the share market will benefit, and I think the property market probably will too. So the housing market should fare better in 2026. House prices in New Zealand up about 0.5% in 2025, so they've done absolutely nothing at all. And the last 3 years, they were down, negative in 2024, 2023, and 2022. So the housing market has been very disappointing in recent years. Now, lower interest rates are a very obvious driver of the housing market faring better, but don't underestimate how important greater job security will be as well. Now, if the labour market improves, and I think it will, where's the unemployment rate? 5.3%, I think it is. I'm hoping that is as bad as it gets, and that next year, as you see an economic recovery take hold, firms will be more willing to hire, to take on staff, and this will prove to be the worst point for the labour market, and you'll see unemployment come down a little bit. Now, that will make a really big difference for sentiment and confidence, and sentiment and confidence are crucial. They are super important. People not only need to feel comfortable that interest rates aren't too high, they also need to feel that they have got a stable job and that they won't lose that job. So I think that's a really important piece of the puzzle, not just for the housing market, for the economy generally though, but it will make quite a difference to housing. Now, just to be clear, I'm not expecting a repeat of the boom times. I don't think we'll see, 9, 10, 12% per annum house price rises. I think affordability is still against us. You've still got policy headwinds. You've still got other challenges. So for me, annual house price gains in that 4 to 6% zone seem more reasonable. Speaking of politics, that will be in focus in the US and here in New Zealand. We've got the midterm elections in the United States taking place in late 2026, and we've obviously got the next New Zealand general election, and they haven't set a date for that yet. It could be September, could be as late as November. We'll wait and see. I am a firm believer that you should never let politics have a big impact on your investment strategy. You've got to pay attention to policy changes, who might get in, what they might do, the winners and losers, how it will affect confidence, obviously. But you just don't want to let that completely drive your investment decision making, because there'll always be something happening on the political front. So those winds will always be shifting. We've got to focus more on fundamentals, the economy, inflation, interest rates, growth, migration, all of those sorts of things. Corporate earnings are the ultimate driver of share prices. So that is what we should always focus on. However, next year, thinking about the midterms, the first several months of midterm election years can often be a bit more of a grind. Sometimes you see US shares go sideways over the first half of the year and then perform better as you get closer to those midterms and in the wake of them. And I think the same is sometimes true here in New Zealand. In the lead up to an election, the environment is always characterised by uncertainty. Who's going to get in? What are they going to do? Maybe Labour will get in and it'll be that targeted capital gains tax. What have the Greens got in mind? What does ACT want to do? What if Winston Peters again holds the balance of power? What's he going to ask for? What's happening with the KiwiSaver contributions, government debt, the retirement age? We just don't know. So there's too many unknowns, and that uncertainty often does prevail through an election year. So we just need to bear those things in mind. And that's especially true when an election is expected to be close. And this one here in New Zealand, in little under a year's time, at the moment looks like it could be a close one. So watch this space. We need to keep tabs on some of those policy positions as they come out. There's a lot of water to go under the bridge. We'll wait and see how the economy develops. A stronger economy obviously is something that an incumbent government wants, because recessions tend to get you voted out. So this current regime will be hopeful that the economy does improve, as we're all hoping for. And budget day. Budget day is kind of boring a lot of the time, but in an election year, budget day is much more exciting. So late May, that usually comes in. Anyway, that's all from me. Take care. Enjoy the holiday period ahead, team. This year was a really eventful one across financial markets. I have no doubt that 2026 will bring plenty more action. So thank you very much for listening. We appreciate your support. Keep listening. There will be plenty to come over the holiday period. We will not go quiet. I'll pick up the microphone very frequently and share my thoughts. So keep tuning in. Thanks again, and we'll talk soon.
For more insights, visit craigsip.com.